Okay, so I'm going to tee up Brian Wilson, market strategist, veteran of market structure, for part one. Brian, all you.
Sure. Thank you, Tim. Good afternoon, everyone. Great to see everyone again. Hope you're doing really well here in mid-January, right in the middle of options expirations. As I was looking at some of the data recently, a couple of trends, I noticed a couple of trends from a sector perspective, and I just wanted to show you what this looks like as we kind of look at sentiment and short volume data over time, and how predictive it can be. And I think you can see this playing out. And I'll share my screen and we show you what I'm talking about here. All right, so what I did here is I did an exercise where I looked at 20-day activity from a sentiment perspective, from a short volume perspective, and then I got performance from each sector. We'll start with the broad market. During the last 20 days, broad market average sentiment was 5.92, short volumes of 49.6%. And if you look at that, and then what I did, I was looking at outliers. I'm like, okay, and I think it was healthcare that really caught my attention. Like, okay, healthcare's had really strong sentiment. What's the performance? What's their performance been? Well, it's the strongest performance really, other than big tech during the course of the last month. Stands to reason, right? Sentiment much higher than the broad market, short volumes much lower. And once again, other than big tech, that's the lowest short volumes that you'll see on the board, basically best performance. So just kind of interesting when I was looking at that. You look at some of the other considerations here. Financials a little bit stronger from a sentiment perspective. Short volumes not too bad. Basically flat performance. You look at some of the others that really suffered during the course of the last month. You'd say, okay, that's probably fairly predictive. Let's look the other direction. Look at activity where we had weaker trading. Look at the utilities. Worst sentiment on a 20-day basis. I believe, other than consumer discretionary, that's the worst short volume. Look at performance, down 3%. Speaking of short volumes, look at consumer discretionary now, basically right in line with the broad market. Short volumes very, very high at 51%. What was their performance? Down about 4%. Now you can see this very easily, and you can see the trends playing out over time. We talked about consumer discretionary there, and I'm just on the normal dashboard, and you can see I have another number of other portfolios, but you can see this very clearly. Look at consumer discretionary, how high those short volumes have been over time. We talked about big tech. Look at how low their short volumes were going into the early part of January. I think that helped big tech to really kind of outperform everyone else. And we had talked about that maybe a week and a half, 2 weeks ago, in terms of big tech probably going to hold things up a little bit just because of the fact that short volumes were so low. So that was really the first area that I wanted to cover. Once again, the concept here is just look for outliers. And if you see sentiment, if you're trying to pay attention from a sector perspective, look for those outliers. In this case, during the last month, you could see it with healthcare, both from a sentiment and a short volume perspective, much, much lower than the broad market. Certainly, much better outperformance. And before I leave this topic, and I think I have this hidden, let me unhide this. Here's the components of our big tech portfolio, and it's a good lesson. What I wanted to show you, we had outperformance during the course of the last 20 days from big tech, but look at the different components here. You move from 1% to Amazon, negative 15%, Tesla, -7.5 with Apple, 15 AMD, 15 NVIDIA, 10% Meta. So just a little bit of a reminder, you can always have outliers within a group that will can move things one way or another. You guys are aware of that, but I just wanted to share kind of a real life example how it's played out in big tech during the course of the last month. So that was the first item I wanted to cover today. The second item has to do with SPY and what we've been seeing there. And what's going on with SPY, and I'm going to back this look up for a one year look. SPY anymore is something that I'm tracking every day, and I'm just looking to see whether there's any outliers. So this is the ETF, of course. Tim has done an incredible job during the course of the last 3 or 4 days talking about some of the potential arbitrage implications. But what I wanted to quickly walk through here with SPY, I wanted to highlight, I believe it was 5 different segments. And I won't spend a lot of time on this, but where have we seen SPY outside of the norms here during the last year? And this is a 1-year look. So we're going to take a look at this section right through here. The next one was in the summer, this section in right through here, this section through here, December, and then where we are right now. The takeaway, or what I was trying to unpack as I did this exercise, is what can we learn when we see like tremendous short covering? And you can see the section we're in right now has been the strongest short covering that we've seen during the last year. Are there any takeaways that we can get when that is happening? So here's the 5 different sections that I just showed you. I won't go through this whole spreadsheet, but just kind of go through some of the takeaways here. So as we were in January, we were in that low short volume environment for SPY for a period of about a month. By the time we exited a month later, sideways trading. In July, very similar, shorter time frame. We were in that low short volume environment for about a week and a half, 10 days, basically sideways trading once again. We had 2 periods, late September and then early part of December, where we did have some advances as the SPY was going higher. And I'll show you what this looks like here in just a second. And then the most recent one, short volumes have stayed really low for a long period of time. Look at where we were from the SPY going into that period. Look at where we are as of yesterday. Once again, basically flat trading. And I'll show you these periods here briefly from a big picture perspective. We'll go to broad market sentiment and kind of unpack this. So taking this back, this look back a year, and that first period was January to February. So it started January 23rd. So right through here, what we were tracking, and this was interesting, you can see short volumes actually very low across the market. So not only was SPY getting covered at the same time, but short volumes across the market were getting covered. So very different than the setup that we have right now. What did we see in the market during this time? Well, we saw the market initially going higher, and then by the time we ended that exercise, the market had faded. Sentiment was declining at the same time. Let's go to July, and it was July 3rd, so right in here. So a little bit different environment. Sentiment was green is sentiment. Sentiment had been bottoming. Short volumes once again low across the market. So low short volumes for the S&P 500, low short volumes for the SPY. And in that case, the SPY didn't stay low for long, but you can see that broad market sentiment had been climbing and the markets continued to climb. Let's go to the end of September, and I'm sorry I can't have both SPY and the S&P on the same chart, but hopefully this exercise is somewhat helpful. End of September was right in here. You can see a little bit of a different environment. We had been declining for broad market sentiment, and this is one of the times where the market rallied by about 2.5%. We'd have to say part of the reason for the market rally is we had moved below that green line. Broad market sentiment quickly spiked, and so did broad market performance. Two to go, one here on 12/8. This is actually similar to the last time where we had been moving lower, but broad market sentiment suddenly moved higher, and we had had nice performance from an SPY performance. So let me give you the takeaways here, and I'm sorry if that was a little bit difficult to track. But for me, as I was looking at the data, I saw three general takeaways. Generally, when we get that movement from an SPY perspective, and once again, here's what I'm trying to show you. Take this back 1 year. So when we get periods of time where the SPY is moving below trend, like here in January, like here in the middle of the summer, here in October, and then once again in December, what's our general takeaways when that is occurring? Well, we generally won't see market declines. Now, this is a 1 year period. Granted, we're not taking this back 5 years. But you can see that for none of these periods did we really see any market declines. 2 of the periods had immediate advances. And speaking of advances, usually the market will move higher, immediately when we see this happen. The longer that we kind of stay in that environment, and as the SPY short volumes normalize, returns will start to fade. But if you looked at some of those periods, we saw kind of immediate appreciation. So that would be one of my takeaways. If you're in a higher short volume environment, let's pretend that we were here, and suddenly short volumes go really low for SPY, well, you're generally going to see advances afterwards. And the disclaimer, of course, is that this is a 1 year look. So that's what I wanted to show you there. 3 basic takeaways there from looking at the data over the course of the last year. Last point I wanted to cover today, hopefully I'm not taking up too much time for Tim, but I wanted to just talk about our setup right now. And as I'm going out to some of our clients on the investor relations side today, I'm discussing a little bit of, and I'm calling it a precarious setup. And here's why. Here's demand that's fading. So this is the S&P 500 that you're looking at. The green line is demand, which has been fading into options expirations. Look at short volumes just accelerating higher. Now, to me, this can go one of 2 directions. Recognize that with expirations, it can be an inflection point. Part of the reason for that is market participants are making decisions regarding leverage and hedges, and each one of those decisions is going to have a cost associated with it. Do they want to roll their hedges for the next period? Do they want to roll their leverage? You go across the marketplace, and as I mentioned, each one of those decisions has a cost. What do they want to do with that? Well, look at the setup right now. There's short volumes shooting higher. There's demand moving lower. To me, it can be similar to September, or it can be similar to October. If we move back to September, we can see that demand here had been declining coming through options expirations. And then we very briefly started to move higher. Wouldn't surprise me if we get a similar move higher this time, but then look at what happened. Demand then accelerated lower and the market went lower. So to me, that's one way we could go here, where we have a brief move higher in demand, but that demand move higher doesn't stick, and then we get further downside. The other way I could see it playing out here in the next couple of weeks would be October trading. So if we look at October, we can see that demand had been sliding after expirations. Short volumes had been very high, very similar to where we are right now. But look at what happened coming out of expirations. We immediately started to get short covering. You can see that down here on the bottom. We went below that green line, which you can consider to be oversold. And then that started our rally that has really lasted until the beginning part of January. So from a broad market setup, I don't know right now which way we go. We are at a potential inflection point, and we've seen short covering in previous time periods when we've been at similar inflection points. But we could also, do something similar to September, as I showed you, where we have a brief rally higher and it just doesn't stick, and perhaps there's more downside to come. Now, the good news is if we do get further downside, look at how close we are to the green line. The market rallies when we move below oversold conditions. We're not far from those conditions right now. So I have taken up more than my time here. Thank you for your patience, and I hope that was helpful.
Great, Brian. Yeah, that was good stuff. Yeah, very, very useful. Thank you. And I can segue into that with the things that I'll cover. I've got 4 items, but we'll see. I can blend a couple of them. I wanted to, because I mentioned this in in one of the market desk notes this week, that I would talk about market behaviors briefly. And why don't we put them on the platform? I think you can see my screen now. So this is SPY for 1 year, and what it's showing you is the general composition of daily volume on average in SPY, where this is, and hopefully you can see my cursor, it's a little larger. This is active investment, meaning stock picking, where business performance is the principal motivation. And believe it or not, this is higher than in the average stock comprising the S&P 500, which is, call it 9.5%. And it tells you there are closet indexers who are simply buying SPY in place of buying a basket of stocks because it's easier. It's liquid, very easy to trade. This 27%, this is passive investment, meaning even index funds and global macro funds are using SPY as a proxy for exposure to the S&P 500. Again, makes sense. They're very liquid. This is Citadel. I always use that as an example. We call it fast trading. There are all kinds of things you could call this. An investment horizon of a day or less. It is computerized trading. It's the thing that makes most of the bids and the offers in the marketplace. And it's a little less than half of the total volume in SPY. And then 19% of the volume, it's all model driven, but we're very accurate at predicting prices, which is how we know that we're probably getting these numbers correct. And they're validating approaches too from other sources that arrive at something similar. This would be trading SPY because it's pegged to a derivative, like an option or a futures contract related to SPY. And I mentioned, and you say, well, wouldn't it be helpful to know which of these things is leading? Well, they all have to conform to the same rules. If there was statistical significance to one behavior leading versus another, believe me, we would put significant focus on that. But statistically, there isn't. Those aren't the things that are predictive about which direction the market is going to go. It's very helpful for public companies. When a CEO is on, I'm not picking on the CEO of Workday, but I'll mention something he said today. So I saw him on CNBC from Davos this morning, and he was asked about, well, why is the stock up whatever it is over the last year? A lot. It's not back to its highs from 2021. And he said, well, we've really been executing on the business plan, and we're growing, and we've got this thing going for us and that thing going for us. And I thought, that is not the reason. If active money was 89% of the market, that would be true. But it's not. It's closer to 10%. If you look at the ownership of Workday, the stock pickers are shrinking. They're net sellers every quarter, not net buyers in the main. There are always exceptions. I'm just talking about the central tendency. Stock pickers have lost $500 billion a year for more than a decade to indexes and ETFs. So it can't possibly be true that it's your fundamentals that are driving it. What drives it? The market is motivated by two simple things: catalysts and characteristics. Overwhelmingly, the money buys characteristics, which means things that make this thing similar to other things. Catalysts are what make them different. And I've mentioned this before. Less than 1% of stocks consistently outperform the benchmark, and they're not the same ones. Nevro, when they had a catalyst, NVRO, they performed magnificently. When they no longer had a catalyst, they did not. NVIDIA has been around a long time. The company was started in 1992 by Jensen Huang. It's only in the last number of years that it became the 1% of outperformers. I mention these things because we do track this. This is what you see across your dashboard. If you look at this leading behavior, that's the demographic. And more often than not, it's going to be passive money or fast trading, because you put those two things together and they're 75% of all market cap or volume. And if you extend it to derivatives, now you're at 90+% of the market is some form of those kinds of behaviors. The only thing being led by active money on my dashboard right now is big tech. And I think, it's where money goes. It's easy stuff. And does it tell us anything about how that money will behave? I don't think that it does. But if you see this, if you want to get an explanation, it's here. We'll tell you about, here are the key behaviors. What is active investment? What is passive? What is fast trading? What is risk management? That's what we call those four things. So we track them and we impute their percentage effect on prices, and we can very accurately predict short-term prices. Notice that everything we do is short-term because that's how our models are effective. If I go look at, we can forecast the price of SPY or any stock out 5 days. We run a calculation based on changing behaviors and prices, and we project forward where it's going to be 5 days out. And we're very accurate. There are periodic swings where when standard deviation is very high, it tends to be indicative of a change in the direction of the price. But generally, this is a 98% correlation between our two forecast bands and the midpoint of SPY. This is why we talk about volatility. It's why we talk about probabilities. By the way, Steve Hicks, this is especially for you. I had a meeting with two meetings today on our probability calculations that we're doing and machine calculating those. And then the chief engineer who's working on creating those probabilities and entries and exits, so we can go right to how do we produce a return in 1 to 5 days with very high probability. That's what we're trying to do. And we learn, we get better at things. I mean, we've studied these data a long time, but trading is different from data analytics and understanding what the purpose of the money behind price and volume is. And so we're working on, that's where we want to be, because really that's how the market is structured. It's what the rules favor. And so the summary of this is, it's important to understand what is actually occurring in the market, what the money is doing, but it all rolls up to supply and demand. That's what all those four behaviors become this. That's what it is. They're all inputs. They're all purposes. Everything that occurs, whether it's global macro data, jobs data, jobless claims, you pick the data point, that the money that is motivated by that is going to make its way into these measures. So I wanted to explain that. Any questions, comments, thoughts about that before I move on to the next thing?
Are you still on the 1 month prediction of having this done?
Yes. Yeah, I believe that by the end of January, we will have tested it and reached a point where we could, yeah, we're on track. I had a couple of updates from the engineer, and he was right on track today. So
Excellent.
I think
Excellent.
so. I think that's good. If you hear noise in the background, Clyde the hound dog is barking at, I think there's a police officer going by, so apologies. Next thing on my docket is and it dovetails with some of what Brian talked about, and it's why do we track monthly options expirations? We're in it right now. Today, AM dated index options expired at noon Eastern time, about when the market changed direction. In fact, I was trading instant messages with Brian Wilson. I had a meeting, otherwise I'd have done it. I said it should be short in the market right now. If the market goes up 50 basis points, the S&P 500, there is a high probability that it will reverse. It's not absolute, but why do those things occur? Well, it's all related to all the things that you can arbitrage. Stocks move about 2%. You could calculate this, by the way. You could create a portfolio like mega caps here. If I want to know what the volatility is in the mega caps, and I've just set up I'm looking for everything that isn't small cap, or sorry, everything's 100 billion in market cap or more. So that's large cap, right? That's a criterion you can choose from up here in the dynamic portfolio settings. Then you could output this to Excel, and then you could run an average of what the volatility is to find out and you could check it against small caps. You could do the very same thing with small caps. Create a portfolio, dynamic portfolio, and say only small caps. There are about 2,000 of them, and find out what the average volatility is. You will find that in the broad market, it's about 2%. And in SPY, right up here, I had it all teed up, it's about 1%. And then you have the associated derivatives and how those move and produce larger returns. Many of you are experts at trading options. I'm not, probably should be. It works pretty well. But the reason the monthlies matter more than the weeklies, there are all kinds of things, the 0 days to expiration, not going to be any, you're not moving an asset. But these things, where these green squares show up, this is monthly expirations, month-end expirations. We track both of those, monthly, month-end. And notice that the market often, not always, does something different at those points. And it's because there's an asset movement. If you have a position for a month, someone's going to move some proportion of the asset that is associated with that. If it's Goldman Sachs making markets in derivatives, they're going to have an associated asset position and a hedge against their exposure. And all that stuff's going to come up to a date certain, and it will get renewed. Could get increased, could get decreased, could change significantly. And we don't know exactly what's going to happen. But you can get a pretty good idea looking at the data. You could look at the data here and say that between December expirations, what was happening at December expirations? Look at short volume. Is very low. Well, it's probable that money is leveraged long. That can change, but it's a pretty good read. And why would that be true? Because if I'm hedging my exposure and people are buying calls, not puts, I'm long. If they're buying puts, I'm short. If it's a mix, I'm dead even at 50%. Right? So it's not a perfect read, but this was a pretty good read back in November too. Into coming out of options expirations, people levered longer and the market continued to rise. It was pretty clear that was what was occurring. What we don't know at present, you say, well, it's the opposite. Well, I think there's a thing that has happened between here and here. I can't prove it, but if you look, as Brian Wilson mentioned, at SPY and compare it, it suggests that because the monetary regime, monetary policy, interest rate policy, the signals are that has changed. And so people adjust their models accordingly. And I would say generally money has shifted longer equities. Now, again, that can change. I don't know what's going to happen, but I look at this data and say that once the Federal Reserve had signaled, well, we're probably not going to continue to raise rates, what happened? We had epically low supply in step with options expirations and a booming market. The booming market is a consequence. It's not the cause. It's the supply demand change that resulted from massive global macro shifts in the way that people looked at risk. Now, they could be wrong. I don't know. But that process has stopped. And so then we saw the market stumble at options expirations this time because look at the supply. And the supply, as Brian Wilson pointed out, it's very, very high. These are all things I look at every day, which is I'm blending all my points together here. Every day I look at edge and I look at how many components are in momentum. Five, this is not correlated to the market's performance, but I look at that and say it's chancy to trade momentum. So I'm probably not going to do that. Low volatility is a much more highly correlated reflection of the market because all that money in models, the JP Morgan money running it, they're huge. They've had such success with these models. The dimensional fund advisors models, the geode capital models out of Fidelity, BlackRock's Aladdin system used by close to $20 trillion of assets for risk management. They're all about low volatility. What are they going to do? They're going to look for low volatility stocks. Now, we have a lot of criteria in here to try to maximize the liquidity characteristics, but this is much more indicative of what the market's likely to do. And what's it been? Hasn't given us much direction, but it's given us low volatility. Not a lot of movement in the broad measures. Always fluctuations with options expirations. But those things, I'm going to always look at that. That tells me, well, the market's kind of a low volatility market. Then I look at all my supply demand lines, particularly big tech. Big tech's got rising demand, but supply that is well above trend. It's headed the right direction, but that's interesting. That doesn't tell me there's a lot of room for those to move. Could have shorted Tesla and gone long AMD and made 30%, right? There are differences. So I always look at those things. So low volatility, momentum. I look across my dashboard. I look at broad market sentiment every day to see what's happening. This is bottomed. This continues to rise. What does that tell you about the market? Well, it's difficult to say. Generally, demand trumps supply. It's not perfect. Now I would add SPY to this mix. I like to look at SPY because of the pervasive use of derivatives. And I just look at it's going to be 5 most of the time because it is the market. It is the reflection of how the market functions today. And so most of the time it's going to be at 5, but I'm certainly going to look at the trends. And as Brian Wilson pointed out very effectively, this was a core signal to me that people were levered long in derivatives because it is the most widely used hedging instrument in the world is derivatives on the S&P 500. And so if this is significantly low, once again, it tells us that the market is leveraged long. That does not mean the market will be off to the races. It could be. Don't know. We'll just take the data every day. I really don't care. I'm not trying to predict what the market will do. We're trying to profit from what it tells us. And that's the key. If there's momentum, trade momentum. If there's not, I like to trade what the market signals. And I don't get it right every time. Yesterday I failed. I lost $250, but that's all I risked by going long and short. If I look at this and say, like what I would have done today, is if the market's up 50 basis points, why does that work? It's half of SPY's volatility. The market makers are going to know that and go, well, I think I'm going to shift short. It's a machine. They're machines, the 50% of volume. And it doesn't work every time, but then probably the market retraces most of that. Take that, and you're kind of done for the day. If you do that with a leveraged instrument and you make 1%, that's where you go. That's all you have to do. You could do it in 20 minutes and go do something else with the rest of your day. Then you come back the next day and see if there's another opportunity. And that way you're not just sitting there hoping that something goes your way. It's really very heavily data driven. You know the supply demand equation, you understand volatility, you understand the risk. What if the demand's flat and supply is rising? What's the risk? Well, that my directional bet might not pay out. Well, don't take much risk on it. It starts to move on you, get out. Those instruments are so liquid, it's very, very easy to get in and out. And it's kind of the best thing to do at these junctures. Once we have a lot of entries in the momentum portfolio again, we can shift back to that and trade that with high confidence, but we're not there yet, right? So, and we won't be probably until Tuesday, Wednesday next week. Why? Monday, new options trade. Is we going to see? Will we see the same demand? Will that massive amount of supply that we have in the market tell us that the market makers who created all of that stuff have shifted short and the market falls off a cliff? Could happen. I'm not saying it will. Tuesday will square the books. Wednesday's reality. And if demand's rising and supply's falling, the market's going to rise. But we'll just see, right? We don't have to worry about it. We'll just see how it goes. That is everything I had to cover. So I'm going to stop sharing. Any questions we've missed? Any words of wisdom for us before we leave? I'm always looking for words of wisdom, you know. Frank, nice to see you. Glad you made it in. Good. Okay. And if I miss you, Gary Morris, good to see you. Glenn, thank you for being here. I trade notes with a lot of you folks, so I appreciate that. Yeah. All right. Good enough for today.